Hi, my name is Montalbano. This is my Dr. Cresson 452 investment strategy project. My investment strategy I've chosen was to invest in high ROE stocks. High ROE is basically the net income after tax over the shareholder's equity. Basically, ROE is just basically the profit of which stocks receive every year. So if the stock's growing and it has a higher ROE. ROE shows, once again, how much profit a company is earning of its net assets, and the more effectively management uses the company's resources, the higher ROE. So basically, high ROE just makes the company more stronger. They're doing everything right. They're making their money. Once again, ROE measures a corporation's profitability by revealing how much a profit a company generates with the money shareholders have invested. The reason why I chose to choose ROE was because Warren Buffett highly believes in it, as well as Peter Lynch and John Neff. They're great investors, very successful investors. Warren Buffett, for example, has targeted companies that have averaged an ROE of at least 15% for the past 10 years. So, I mean, if it works for him, I think it would probably work for anyone. Alright, so what I've done is I've used the Dow Jones Industry Average, which is the top 30 companies. They're the large cap companies of the United States, the top 30, like Apple, which has recently became part of the Dow 30, as well as like McDonald's, Nike, Verizon, Visa, ExxonMobil, IBM, all a bunch of different industries. I'm trying to be diverse just to see if my statistical analysis is proven. So we'll go through, and what I've done is I went on ycharts.com and I have found the ROE percentages from all the Dow 30 companies, and I went on Yahoo Finance to find the 52-week return for every company from 2013 to 2014. So when I did this, I ran the regression, and as you see here, the p-value for the regression was 0.78. Well, the goal is to be under 0.05, and obviously I did the p-value is greater than. So my result for my regression is that the p-value is higher than 0.05, which means there's no correlation between the high ROE and my return on the investment, which means ultimately there's no relationship between both. Now, why are they not correlated now? Maybe my sample wasn't large enough. Maybe I should have used maybe the top 100 companies. Maybe I should have used the S&P 500 as my benchmark. It might have been driven by a high equity multiplier. It might have been more levered. I chose a bad test. I might have chose something different. Doesn't prove that you will make more money with a high ROE, basically, is what the result is. ROE doesn't compare one industry to another, and basically ROE is impacted by how quickly assets are turned, debt, and profit margin. So I'm going to end off with my presentation from great Warren Buffett's quotes. Risk is a part of God's game, a light for men and nations. And today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset. One pays virtually nothing and is certain to depreciate in value. And I feel these two quotes really come together for what John Cresson has always expressed, was more about risk and return. If you're not willing to take any risk, you're basically losing your money keeping cash. So if you throw a little risk in, know what you're doing, and be smart about your investments, you really never know what type of return you'll ultimately get. This is the end of my presentation. Thank you.